In this week's video, we'll review the latest charts and data to help us answer the question: breadth thrusts that were nailed down on Thursday, do the charts overall align with the rare bullish signals or contradict them? We'll be moving quickly, so feel free to use the pause button on your video player. This is a research report from our buddy Dean dated Friday, April 25th. Title of the report: A Cluster of Breadth Thrusts Bodes Well for Stocks. Key bullet points down here. Study on the right side of your screen. The NASDAQ composite, after advancing issues, outpaced declining issues by a ratio of 3-to-1 in 3 of the last 10 sessions. 3 months later, 100% of the cases the NASDAQ composite was higher, average gain 12.9%. A year later, 96% of the historical cases were higher, first signal dating back to 1974. Average gain a year later, 29% of the NASDAQ composite, median 26.1. We'll revisit these thrusts later in the video. Prior to covering some of these signals in more detail, let's make these points. Many of these signals were triggered during Thursday's session, which means the look of the charts and the weight of the evidence on Thursday is the more relevant day. Why? Because we want to see if the weight of the evidence aligns with or contradicts those signals that were fired on Thursday. So many of the charts that we're covering in this week's video are purposely as of Thursday's close, to give you a reference point how things finished up for the week. Top of your screen here are the full week returns: S&P 500, NASDAQ 100, gold, and the VIX. And since we talk about many ratio charts in this week's video, as of Thursday's close, and if you want to get some insight relative to how those charts as of Thursday's close evolved on Friday, in Friday's session, tech and growth outperformed. The triple Qs performed well, and the S&P 500 itself performed well. They all outperformed defensive type ETFs, value, and the VIX. And that's also represented in S&P 500 sector performance as of the close on Friday, April 25th. Defensive consumer staples, real estate and utilities underperforming. Inflation-friendly energy and materials underperformed. Outperforming communication services, consumer discretionary, and XLK, the information technology sector of the S&P 500. The orange line is the anchored volume weighted average price line on the day the S&P 500 bottomed in October of 2022. Blue line is tied to the peak prior to the bear market. You can see it acted as support and resistance, somewhat more like a magnet in here. This is an indecisive period. And you can see when the tariff news became less bad, the market made a stand at a logical level. The blue line also represents an area of possible support. However, if we look at the high-low close bar, we've already gone down and tagged that blue line. Keeping in mind, it's not unusual for markets to overshoot. Same exact concepts with the NASDAQ composite. The orange line is the day the S&P 500 made the major low in October of 2022. You can see the NASDAQ came back and tagged that line on the day of the tariff pause. Since then, it's made a higher low and a slight higher high here. It obviously still has work to do. You can see in October of 2023, the lines also acted as support. In here, they acted as resistance. The NASDAQ 100 came back and tagged the red anchored volume weighted average price line. That was tied to the day the NASDAQ 100 made its final low in October of 2022. You can see this is when the tariff news became less bad. If we go to the high-low close bar chart, you can see the orange line, the day the S&P 500 bottomed. We came down and tagged it intraday over here on the right side of your screen, and thus far have held in a very logical area. On the chart of the S&P 500, you can see we made a stand at an extremely logical level in October of 2023, and we came back on an intraday basis and tagged the blue line. That line held in October of 2023, and it marked the end of this correction in here. We're covering charts as of Thursday's close because that was the day that the Zweig breath thrust triggered. Why is that relevant? Source of the data on the left side of your screen. Here's the Twitter handle, upper left-hand corner of your screen. The smaller data set over here, here's the source here with the Twitter handle. On the left, it's a higher standard. 1 month later, 86% of the cases, the market was higher. The median gain was 5.1%. Notice some type of relatively muted drawdown would not be unusual. Looking out between 1 week and 6 months, we have to have realistic expectations about how markets operate in the real world. Data set on the left, 1 year later, 100% of the historical cases higher, dating back to 1962. The median gain in the S&P 500 12 months later was 26.4%. Similar data up here, a little bit lower bar to clear, but basically the same signal. 100% of the cases higher a year later. Average gain 23.78%. Notice there is some red in this table here. There is some red in this table here. We have to maintain realistic expectations, even under the best of circumstances, relative to how markets operate in the real world. As of Thursday's close, we had cleared numerous hurdles. We still have one more to clear. That helps us keep an open mind about a wide range of outcomes, especially over the next few sessions to next few weeks. Confidence would incrementally increase if we can clear the orange line at 55.58. The longer we stay above the line, the more relevant it becomes. It's impressive that we've been consolidating in this region here above the anchored volume weighted average price line tied to this high, and also above the anchored volume weighted average price line here, the red line tied to the announcement of tariffs on April 2nd. So it's good that the breath thrust occurred within the context of these major charts making a stand at very logical levels. The broad value line geometric index. If you pause your video player here, you can see the market made stands, very logical levels. We came back to that same level. This is the end of the 2022 bear market here. This is when the correction ends in October of 2023. And this is the less bad low that we recently made relative to the tariffs. You can see the S&P 500 is in the bottom portion of your screen in this bottom panel. The blue AWOP line for this ratio, AGG relative to SPY, a diversified basket of bonds relative to stocks. The light blue one is the date the S&P 500 made a major low in October of 2022. This region in here is where the NASDAQ made the major low. You can see we came right back up to that area, an area of potential resistance, and pulled back in a manner that aligns with the breath thrust. This is a very encouraging chart that made it easier to remain patient during the recent episode. This is AIQ, the Global Artificial Intelligence and Technology ETF relative to SPY, the S&P 500. This look over here on the right side of your screen, the market is trying to tell us that this downtrend over here that began in 2021, trying to end that in a convincing manner. You'll notice down here we're holding near logical levels. And this ratio has spent more time above the colored lines recently relative to being in the lines, in between them, or below them. The fact that the lines are converging tells us this is a very important area. And if this ratio can go on to print a higher high out here, it would be a good sign for former market leadership. When the tariff news became less bad, we held at a very logical level over here. The purple line is tied to the major low in this ratio from October of 2022. If you pause your video player here, you can see when AMLP, Master Limited Partnerships ETF relative to SPY, when it stays in this range, the pattern has been when it's rejected at the top of the range, the S&P 500 bottoms or we're flipping back to risk on. That's the bottom panel on your screen. This is the major bottom over here in October of 2022. This is the correction low in October of 2023. You can see we're back up with a similar look in the present day and being rejected thus far near a logical area. Same ETF for the numerator, AMLP. The denominator has changed to XLK, the tech sector ETF. January of 2019, after the low down here made on Christmas Eve 2018, the AWOP lines act as resistance. Very similar situation over here when the S&P 500 bottom made the major low in October of 2022. Resistance with the AWOP lines. We came right back to that same area, an area of potential resistance, and thus far, the ratio has acted in a manner that aligns with the breadth thrust in a bottoming process. This is one of your emerging leaders, ARKF. It's a leader relative to walking forward from the October 2022 low. It is not a leader relative to your best options when you go out to much longer time frames. Meaning relative to the best options, this still looks like a counter trend move within the context of an existing downtrend. And that may be in the process of changing right now. Why? Because this dotted line here is tied to the 2021 high, and it looks like this ETF is trying to flip the trend in a convincing manner. This would be similar to the area that the S&P 500 cleared back in May of 2023. Made a stand near a very logical area tied to this high and this low in between the red and the blue lines. So credit markets, leverage loans, it's been leading to the upside. BKLN. It's above the anchored volume weighted average price line, the orange line tied to the February 19th peak, and it also cleared the blue anchored volume weighted average price line tied to the April 2nd tariff announcement peak. You're going to find very, very similar themes across most of these charts. The S&P 500 makes a major low here in October of 2022. The anchored weighted average price line in orange acts as resistance. Some of these regions, we came right back up to that line, and thus far that line has been acting as resistance. Similar concepts here, resistance near the major low in 2018 in the S&P 500, resistance near the major low in late 2022, early 2023. We came right back up to the same line. This is EFV, foreign value stocks relative to SPY. Thus far, this still looks like a counter trend rally within the context of an existing downtrend. Having said that, we have to keep an open mind about foreign ETFs flipping the script. Similar situation here, European financials, EUFN, resistance. You can see the ratio starts to move away from the orange and purple lines. That's why the red line is there. Then it acts as resistance in here and in here. We've come right back up to that same area. We do have a multi-year breakout down here. So this too is telling us to keep an open mind about possibly adding foreign exposure to our portfolios. Confidence would increase if this ratio can get out into this region here. That may happen very, very soon. It just hasn't happened yet. Notice the blue anchored volume weighted average price line acted as resistance numerous times here. Then it flips to support in this region here. And since then, FTech, the Fidelity Information Technology ETF, has stayed above the orange and blue lines. We came back to both lines and held on the exact same day that the tariff news became less bad. This too aligns with the recent breadth thrust. Tells us to keep an open mind about these regions being part of a bottoming process or possibly even the final low. Much like foreign investments, gold has done a lot of good things, and we have to be open to the trend flipping. But right now, GLD relative to SPY looks very, very similar to the major COVID low here, where the ratio flipped against gold and in favor of stocks. And it also looks very, very similar to this downturn period in here when the S&P 500 finally cleared the peaks from the year 2000 and the year 2007, and that occurred in 2013. We would refer to that as stage 2 of the secular bull market. Gold looks great in isolation. It's possible that it's not a great time to add to it, but if it can get out here, we would be more open to doing so. Think about the weight of the evidence. Before the close on Thursday, we knew for the most part the breadth thrust was coming based on the data that we had in hand. So during the day, we're looking at these charts trying to say, does this align with or contradict the breadth thrust? And almost universally, they align with the bullish message. IEF 7 to 10 year treasuries relative to SPY rejected near a logical area, and then it went up and made a discernible lower high in this region here. Everything that we said about the previous chart applies to IEI relative to SPY as well. If we were going to go into a deflationary bear market or a deflationary depression, we would expect the chart of IUSB, a diversified basket of bonds, relative to SP low volatility stocks in the S&P 500 index, to have a massive spike or breakout similar to this deflationary fear spike that we saw in 2020 during the COVID crash. If we look at the same ratio today, not really even making a run at this level up here. And this tells us thus far, the market doesn't seem to be overly concerned about a traditional recession, a deflationary recession, or even an earnings recession for that matter. Those probabilities would shift if the ratio can get out into this region here. If you look at thousands of charts every week, as we do, this is one of the better looking relative charts you can find anywhere. This is U.S. core growth stocks, IUSG, relative to SPY. This is the fear of inflation up here and the transition away from growth that occurred in late 2021, early 2022. And this ratio didn't make a stand again until early 2023, so the red line is tied to that low. We've come right back to the convergence of all three of these relevant lines. And thus far, we've held at a very logical area. Why so many lines? We're trying to find out where areas of potential resistance are. And you can see the fact that this ratio, again, growth, this is IUSG relative to VU, is above those lines, is a good sign. You can see in late 2021 over here, prior to the 2022 inflation scare bear market, value stocks IVE started to significantly outperform tech XLK. That's in this region here. Then the trend flipped here in late 2022, early 2023. That's the purple line. And thus far, once again, the area of potential resistance aligns with the tariff news becoming less bad, and it also aligns with the breadth thrust. Having said that, this is a stronger run over here on the right side of this chart than really anything that we've seen in this area here. So we absolutely positively have to keep an open mind about a wide range of outcomes, including this ratio moving out into this area here. But recently, it made a high the day the market bottomed, and then a lower high, and then on Thursday, it made a lower low relative to this low. Since we're using a weight of the evidence approach, it's also relevant that a different ETF, IVW growth relative to the S&P 500, also has one of those. As long as we're above the colored lines, we should be confident about this ratio going on to print a higher high. And if the breadth thrust that we just had was valid, wouldn't it make sense that growth stocks would go on to outperform the S&P 500? And wouldn't it make sense that the growth slowdown may not be as bad as many anticipate? There's that region in here, mid-May of 2023. This is a very important region. And you can see IWF growth relative to IWD value broad, also 1,000 in each case. The purple and the green lines acted as support in this region here and here. We stayed above it, we stayed above it. We've come back down and tested that now. On the bullish end of the spectrum, we've got some work to do. We've got to get back into this region up here. And we also have other areas of potential support if the market decides to backtrack. You can see thus far, even laggard IWM seems to be making a stand at a very logical level near the cluster of these lines here. And it's also holding above this 2018 high here. Over here, this is the inflation fear spike in late 2021, early 2022. We don't have anything like that on the right side of this chart. In fact, IYE energy relative to SPY hasn't even made a run at the colored downward sloping lines. So we showed a chart earlier that said the market doesn't seem to be terrified of a deflationary bear market, and this chart shows that nor does it seem to be terrified of an inflation-induced bear market similar to calendar year 2022. If the look of the chart changes, we must be willing to reassess those statements and probabilities. The leadership question here is difficult. Financials look good, and they have been outperforming for some time. Tech has been weak and underperforming for some time. But if we review this long-term chart that goes all the way back to the 2016 election, thus far, this looks like a counter-trend move that's getting rejected in a similar manner to the region where the S&P 500 bottomed in late 2022. S&P 500 has a major low here on Christmas Eve 2018. S&P 500 has a major low here in October of 2022. We've come right back into that same area of potential resistance. We've now printed a lower high and a lower low on the ratio. And the weight of the evidence tells us all of these charts seem to be reversing or holding near logical levels just as the tariff news became less bad, and now as they're moving away or moving above, we get the breadth thrust. So we can't predict the future, but based on the probabilities, it's getting more and more likely that the low was either already in place or at a minimum, we've started a bottoming process. A ton of charts that have done this, they've come back and retested areas of prior resistance. This is RSPT, the Invesco S&P 500 equal weight technology ETF. So this is an equally weighted XLK ETF. What once acted as resistance in here may now act as support over here. We're also trying to make a stand at those anchored volume weighted average price lines tied to this high here and this low down here in October of 2022. The blue line has acted as support previously here, 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 and here. We also came down intraday and tagged the similarly important orange line. Blue line is the day the S&P 500 bottoms in October of 2022. It also acts as resistance for this ratio when the S&P 500 bottoms in October of 2023. We've come back to that same downward sloping blue line and reversed, made a lower high, and we have yet to print a lower low, but there's a lot of white space in this region here. This is SPHQ, the Invesco S&P 500 Quality ETF relative to XLK Tech. Logical areas up here to anchor, acted as resistance here when the NASDAQ bottomed in 2022, when the S&P 500 bottomed in 2022. We're back to that same general region, and thus far it appears to be acting as resistance again. Blue and the red lines tied to logical areas. These are anchored volume weighted average price lines tied to a prior correction high and a correction low. Also came at the intersection of the orange and blue lines. This is SPY, the S&P 500 ETF in isolation. We made a stand near a logical area on the day of the tariff pause, and we also have a look potentially of a new rally coinciding with the breadth thrust. There's no question the weight of the evidence, the charts that we're covering here, tell us we've got some favorable and improving probabilities. So we're trying to assign probabilities to the probability of good things happening relative to the probability of bad things happening. And we have to emphasize, regardless of what we're covering today, and regardless of what's happened in the past, the probability of bad things happening is never zero. SPYG growth. We're looking at numerous growth ETFs. Why? Because they keep coming up on our screens. They're some of the best long-term ETFs. This ETF is trying to make a stand based on at least three logical areas. The 50% retracement of the A to B move from the October 2022 low to this high up here prior to the tariff mess. That also coincides with this area here, the 2022 high, an area of major resistance. What once acted as resistance may now act as support, which coincides with the 50% retracement, and also made a stand at the upward sloping anchored volume weighted average price line tied to this region down here, and it acted as potential support or support in here as well. If the market backtracks, this is an area of potential support, and the orange line is an area of possible or potential support. The low here was made on April 8th. Notice how long SPYG relative to SPY has been above the colored bands. We came down and tested this tight cluster of the bands in here, and thus far it looks like we're holding. It would be an excellent sign if this ratio started to move in this direction. The longer it stays above the colored bands, the more relevant it becomes and the more bullish it becomes for the economy, earnings, and SPYG. It's also relevant because all investing involves opportunity cost decisions. Would we rather be in SPYG growth, or would we rather be in SPYV value? Right now, the answer is still clear, maybe on the ropes a little bit, but it strongly is still favoring SPYG as in George. Look at the nice convergence here of two logical lines in the present day. Look how close they are together here. This tells us this is strong potential support. The tariff news gets less bad here on April 8th. Somewhat of a bottoming look to the chart pattern here, left shoulder head, right shoulder, which speaks to human psychology, human greed and fear in this area. And then we get the breadth thrusts that come when the ratio is still above the converging lines. The message of this chart would change significantly if we move into this region here. A short stay wouldn't be too alarming, but the longer below, the more relevant and concerning it would become. We got the S&P 500 on the bottom panel on your screen. So if you pause your video player and you look at resistance at the top of the chart, the days that the resistance went into effect and what the S&P 500 had already done, had already made a low, and then you look where we are on April 8th, it too speaks to probabilities. This is USMV, minimum volatility, versus SPY. You got to think this one through. We flip to risk on here, the exact day where this blue line is pinned. The S&P 500 bottoms in October of 2022. This is where the NASDAQ bottoms in here, the orange line. Thus far, we've come up, hit the line, and been rejected. Has this ratio made a significant higher high? It has not. It would have to exceed this high here to make a significant higher high. So right now, it's a strong counter trend move, and thus we do have to keep an open mind about the trend flipping. It's a noisy chart, but the message is financials, VFH, relative to SP low volatility. So think economically sensitive financial stocks relative to defensive-oriented SPLV. This ratio is holding and held during the entire event that we just went through and are still in above the regions up here that represent an 8-year bullish breakout in favor of VFH relative to SP low volatility. And the ratio has come back to upward sloping AWOP lines. Notice in late 2021, early 2022 in here. So this is early 2022, late 2021. We slash right through the colored lines, areas of potential support. Thus far, we have not done that. The ratio of XLC Communications Services to SP low volatility has pulled back to a logical area and above the upward sloping colored lines. Now, XLC relative to SPY has moved a long way. It's been outperforming for some time, and we've owned it for some time. Now, this is still a really good look when you're above all of the AWOP lines. All of this represented areas of potential resistance, and we were able to break through into the white space. This, too, is somewhat similar to what the S&P 500 looked like in isolation in April and May of 2023. The longer above the colored lines, the more relevant it would become. Even if XLC underperforms for a time after outperforming for a significant period of time, in the early stages, it would look like a counter-trend move within the context of this uptrend, and you'd be coming back potentially into an area of potential strong support. Notice in 2021, when the market starts getting concerned about money printing and mailboxes that are overflowing with stimulus checks, XLE relative to IEF starts to run in a big way. Look at the slope of the ratio in this region in here. You can see it starts to accelerate just as the S&P 500 is peaking on January 3rd of 2022. Compare and contrast the look of the ratio over here in calendar year 2022 and in 2021 with what we've seen since January of 2024. This ratio has not made a higher high since January of 2024, over a year ago. There's a lot of reasons to like XLF. There's also a lot of reasons to prudently limit your exposure to XLF in isolation and rather get XLF exposure via growth ETFs that have exposure to the financial sector and or the S&P 500 that has exposure. Those ETFs are diversified because it's possible that these lines are still acting as resistance. And thus far, this is still a lower high relative to this high here. Down here, the exact day of the low for XLK in 2022 when the bear market, the inflation-induced bear market, ended. When we came back and the tariff news became less bad, the market bottomed on April 8th on this line, and the next day, the tariffs were paused. XLY in isolation, 2023 correction begins. It's the light blue line. The red line is when the correction ended in October of 2023. Those lines acted as support here. Here, we came right back to that level, had an overshoot in what may be a short stay. Even if we backtrack further, this region over here represents an area of strong potential support. Now think of everything that we just covered, all the logical areas of support and resistance that speak to potential shifts in human behavior. Do they align with or contradict the signals on your screen? These breadth thrusts were nailed down on Thursday. All of the charts that we just reviewed were as of Thursday's close, and we did that purposely so we could align them with the day of the thrusts. 200-week secular trend study that we did and talked about on X and in past videos, still helpful. We're still holding in a logical area. It's worth finding this video here if you have asked yourself this question relative to tariffs. These charts were helpful. This is a tweet here from April 6th. All of the work that we've been doing in recent weeks help us keep an open mind about the possibility of a reversal. And thus, as the evidence starts to shift, it becomes easier to redeploy capital. Same is true for the April 9th study that we did with sentiment. The only other time it happened, the S&P 500 bottomed within days and gained 63% from point A to point B. The rare spike and fall round trip in the VIX that we covered on X on April 14th has also been helpful. The drawdown that we experienced after that signal was very, very similar to these historical cases. This was also helpful. S&P 500 chart dated April 24th. Market trying to make a stand at or near an upward sloping 200 week. The RSI study that we've covered in the past. Short stay below 30 weekly RSI and we're back above, trying to make a stand in a logical region relative to history. This tells us to keep an open mind about a wide range of outcomes in the short run, even if good things happen longer term. If you pause your video player, this has a risk-on look relative to the S&P 500 in the bottom panel. As we've noted numerous times, Bitcoin has been leaning risk on, and it looks a lot better than this region back here in 2018. Weekly chart trying to make a stand near a logical level with the trend lines dating back to 2009. NASDAQ Composite trying to make a stand near the 61.8% retracement and 50% retracement of the A to B move relative to the prior rally from the October 2023 low back here to this high. No shift in the downtrend in the CRB index commodities relative to stocks, the weakening momentum against commodities. What once acted as resistance in 2022 Q1, what once acted as resistance may now act as support. We're back to that region. It coincides with the upward sloping 200-week moving average in red. If we look at the backtracking in the Dow on a weekly chart, this really doesn't have the same characteristics as 2000 to 2002, nor the same characteristics of Q1 of 2008. Dow trying to make a stand near a logical area. Last week we talked about how 1929 has some significant differences relative to the present day. When we peaked, we only had about 6 months of support in the rearview mirror here in 1929. And then the first rally attempt, we were rejected at the 20-day moving average. RSI, looking back years, looks significantly different relative to the present day, and the slope of price from here to here really doesn't look anything like, if we look at the same time window, the same number of years, the same chart of the Dow from 2020 to 2025. You can pause your video player. The NASDAQ 100 trying to make a stand near logical levels. What once acted as resistance, 50% retracement of the A to B move. We came back and kissed that 50% retracement and bounced. We said weeks ago that the market had made a stand near these upward sloping moving averages in the past. Thus far, it looks like we're trying to do it again. And we also have this area back here of logical prior resistance that coincides with those upward sloping moving averages. This is a zoomed in look of the prior chart. We're also trying, as of Thursday's close on a lot of these charts, to print an outside weekly bar. Where this week's low is below the low of the prior week, then we reverse in a bullish manner and exceed last week's high. It would be more bullish if we can finish the week like this, above this high. Seems to be a common theme. Major resistance, NYSE Composite 2022. We've come back. What once acted as resistance may now act as support. That coincides with the upward sloping trend line from the low in 2020. We tagged it again in 2023. We tagged it again in 2025. That also coincides with the 50% retracement of this A to B move, and all of that is occurring above an upward sloping 200-week moving average in red. This looks like a false breakdown in the breadth data, and now we've broken the trend from the February 19th high. If the present day morphs into something more like this or this, concerns would increase. Right now, this looks like a short stay below the downward sloping 200-week moving average. What once acted as major resistance in 2022 may now act as support in 2025. As of Thursday's close, the semiconductor index, affectionately known as SOX, was up 9.8% for the week. Remember, on the chart of the Dow in 1929, it had trouble closing above the downward sloping 20-week moving average. We did that on Thursday with a nice strong looking candle on the day of the thrust. All of these charts have work to do. We have to have realistic expectations about how bottoms form even under a best case scenario. S&P 500 weekly, you can see some of these momentum indicators have been improving as the momentum waned. What once acted as resistance in 2022 may now act as support in 2025. Thus far, the look of price relative to the upward sloping 50-month and upward sloping 85-month really doesn't look much different from anything that we've seen since the secular trend started officially in 2013, when price exceeded this high from October of 2007 and this high from the spring of the year 2000. Resistance, 50% retracement, upward sloping trend line, they all converge where we've bounced, all of it occurring above an upward sloping 200-week in red. If we backtrack, we still have that upward sloping 200-week down around 4,700. Since the secular trend began, these moving averages, the market has had a tendency to make a stand near them during pullbacks. Thus far, we've held at the top three lines, which coincides with this point here. Notice the trend lines are still upward sloping for the most part. Nothing alarming on this chart relative to the secular trend chart dated April 24th, 2025. Same goes for this chart relative to the secular trend. A lot of the concepts that we've talked about with the retracements and prior resistance and where we're trying to make a stand relative to trend lines applies to the broad S&P Composite 1500 index. Covered this in the past. The percentage of S&P 1500 stocks above their 200-day moving average dropped below 15%. Typically, when you get a close back above 15, that's a buy signal. Here's the source of this text here. Explains the concept of how you use this data. You can read the annotation. It applies to this chart of IEF. Don't really see any flip in the trend relative to foreign stocks and the U.S. The same concept would apply here. This is foreign stocks, ACWX, relative to SPY, resistance in 2021, resistance in 2023. Thus far, it appears to be acting as resistance as well. Present day really doesn't look like this period in here, BSV, where the market was very concerned about Fed rate hikes and inflation. This doesn't look anything like April 24th of 2025. Here's the flip back to risk on, the flip back to risk on, resistance, resistance, overshoot, lower high, seems to align with the bottoming process and the breadth thrusts and the signals from the VIX and all the signals that we covered last week. FTech relative to the S&P 500 trying to make a stand in an upward sloping 50-month moving average. Also, what once acted as resistance for the ratio may now act as support, and it coincides with that upward sloping 50-month. Nothing particularly convincing on value relative to growth, all of this occurring below a flattish 200-week moving average. IYW relative to VU trying to make a stand at that upward sloping 200-week moving average. What once acted as resistance, a stall, we're in that area. If we can get back out here, that would be a good sign. The The trend became extended. We've come back to the trend. We overshot back here. Let's see if we can hold at the moving average. It was very encouraging on Wednesday of this week when JNK recaptured its upward sloping 200-day moving average. Credit markets, investment grade corporate bonds relative to 3 to 7 year treasuries, what once acted as resistance before the bear market in January of 2022, may now act as support. This is a long-term breakout that's trying to retest. Thus far, it looks like a bullish short stay. This looked like a bearish short stay after a bullish breakout. You notice the ratio of defensive Procter & Gamble relative to SPY turned at several important points, especially relative to the 200-week moving average. Haven't even been able to exceed the 200-week moving average thus far. We have a positive momentum divergence on the chart of RSP weekly. This has been encouraging all along. Growth relative to value. This entire episode here occurred in the context of an improving monthly cloud. We're almost checking all of the bullish boxes. This is growth relative to value monthly. Not really looking like a confident charge or flip to value stocks relative to the S&P. Resistance near the COVID low. Resistance, the low is already in place in October of 2022. Resistance in a similar area with a caveat that this is kind of flattish here. So like many charts, we do have to keep an open mind about a reversal here and us moving out into this area. Having said that, we trade the data sets and the charts in front of us. And right now, this looks similar to this, and this looks similar to this region in here or here. Both of those had bullish outcomes. Is VGT Tech relative to foreign developed stocks? Acted as support here in 2013 and an upward sloping 200-week moving average. Secular trends tend to make a stand at or near an upward sloping 200-week moving average. Once again, we are trying to make a stand there. What once acted as resistance may now act as support. Again, very encouraging. Everything that's taken place since the election here occurred within the context of what is now a monthly cloud that is improving and batting 1,000. This chart was concerning recently, but it's popped back above the 200-week in blue. You can pause your video player. S&P 500 bottom panel for reference purposes. XLK trying to make a stand near a logical region based on numerous parameters. To keep an open mind that volatility could stick around and it may take some time to dissipate this strong downward momentum. XLK in isolation, just as the tariff news became less bad, it made a stand at an upward sloping gold 200-week moving average. You can see it pretty much tagged it. Coincides with the region of the 50% retracement and 38.2% retracement of the A to B move from the major low in October of 2022 down here to the recent peak in 2025. It's also near this region in here, what once acted as resistance in 2022 may now act as support in 2025. Came all the way back to this gap up here from 2024. Support, overshoot. Tried to make a stand at that trend line. First time we got a close above this downward sloping trend line. XLK RSP 4 reference points that tell us to keep an open mind about this trend resuming and staying above the upward sloping 200-week moving average in red. Major low 2016, reversal point in 2022, resistance the present day, reversed XLP relative to XLK near that downward sloping 200-week, defensive XLP relative to growth-oriented XLK. Now remember, we're using a weight of the evidence approach here. So think about all of the charts, all of the representations of shifts in human behavior in the context of the signals on your screen. And when you use a weight of the evidence approach, the evidence builds from week to week. Thus, to conclude this week's video, let's review some of the building blocks that we covered last week. We have to understand our own psychology. Investors are often drawn to forecasts because they promise certainty in a world that is inherently uncertain. I believe we had mentioned this on Twitter. We performed a study a couple of weeks ago relative to where the market tends to make a stand in double-digit drawdowns relative to the proximity of the 200-week moving average. You can see as of April 17th, we haven't done anything out of the ordinary. Every single one of these lines occurred within the context of a secular bull market, where eventually the market went on and printed a higher high and the secular trend remained intact. In fact, the cases that are most like our current drawdown, in terms of proximity to the 200-week and the drawdown that we have, the max draw thus far, being patient and keeping an open mind was highly rewarding. Average gain 1 year later, 33%, 2 years later, 55%, 3 years, 64%. This is not a signal, it's not a forecast. It's just reminding us, as long as it looks like a secular trend, we can't just think about red screens and pessimistic newspapers and newscasts. We have to keep an open mind about a wide range of outcomes, from wildly bearish to wildly bullish. Similar concepts here. RSI recently closed below 30. We performed a study of when that happened. Happened 11 previous times in these secular trend windows up here. If you were patient, the average gain in the S&P 500 6 months later was 12.26%. Only one time within the context of a secular trend were you lower in 6 months, and that wasn't even that bad. 1962, 6 months later, the market was down an additional 6%. Once again, nothing in here that's out of character with the secular trend at this point. If we get outside of these bands, the further we get away from this cluster, the more meaningful it becomes in terms of bearish probabilities. So we'll learn something either way. We always say it's important to maintain realistic expectations about how markets operate in the real world. These are the cases that we just talked about. Notice, there's a lot of yellow and red on this table looking out 1 week to 3 months and even 6 months in the 1962 case. But you'll also notice this. If you were patient and it still looked like a secular trend and all of this was happening either at or near an upward sloping 200-week moving average, remaining patient and not getting too one-sided in your thinking paid off in a big way. Average gain 1 year later, over 27%. And the maximum drawdown on the date of the signal here tells us it wouldn't be unusual if the S&P 500 backtracked to 47.51 or 48.31-ish, which is very, very close to the low that's already been made right around 4,800. Stat here from CyclesFan that says basically what we've seen thus far, all of the previous cases historically were near major lows. Also points out something that we've pointed out on Twitter or X, that breadth has been better than expected over the past 4 trading sessions. Market's still holding above these 3 reference points that we covered last week. This chart is dated April 17th. Jeff combines 3 sentiment readings, and he tweets, you're looking at the highest reading on record in 1,841 weeks of stock market sentiment observations. Basically saying between 1990 and 2025, the most pessimistic or bearish reading ever seen. 10 out of the last 11 cases, the S&P 500 was higher 12 months later, and the only case it was red, it's down an additional 6.6%. But look at some of these returns. 19%, 59%, 36%, 21%, 21%, 30.5%, 25%, 21%, 31%, and even a very respectable 11.5%. Bloomberg article, Bank of America poll shows investors haven't been this bearish in 30 years. Larry noted high volume reversal. We just experienced one. There were similar spikes near the major low in 2009, 2010, 2011, and 2020. The only time it didn't work, 2008. And as we noted over here, 2008, the trend was much, much weaker relative to the other cases and relative to 2025. From Jay, the sentiment trader panic euphoria model doesn't drop below negative 30 often, but when it does, average gain 1 year later, 100% of the cases higher, 31%. 6 months later, 18%. Simply telling us to keep an open mind about better than expected outcomes. Daily chart book, tweet April 12th, history strongly suggests both the NASDAQ 100 and the U.S. large cap tech sector should rally over the next 50 trading days and by double digits, all based on hard data and something that just happened in 2025. Keep hearing about how awful consumer sentiment is. In fact, recently we were told that sentiment in the present day was similar to readings in 1952 and 1981. Things went pretty well walking forward from 1952. The S&P 500 gained 352% to this peak in 1973. Walking forward in 1981, if you had a long-term time horizon, they went extraordinarily well. The gain between 1981, the end of 1981, and this point here in 2000, 1146. Tweet from Seth. When this happens, historically, 100% of the cases, the stock market was higher, average gain a year later, a hair under 30%. From Jay, sentiment trader, NASDAQ 100 performance after the VIX crosses below 45. 1 year later, 94% of the cases, the NASDAQ 100 was higher, median gain over 46%. Sentiment readings, investors have only been this pessimistic and or gloomy one other time, 1990, and the reading that's similar to the present day came very, very close to the S&P 500 low, the end of the red screens in 1990. If you were patient in here, you were rewarded. The S&P 500 gained 63% from this low with extended sentiment and rare sentiment to this high in Q1 of 1994. Markets tend to bottom when the news becomes less bad. We just experienced the fourth most volatile week in 60 years. The other three, very close to the major low after the stock market crash in 1987, very close to the major low at the end of the financial crisis, and very close to the major low at the end of the COVID crash. We also have a drawdown to date that came within a hair of a bear market, but we didn't get there. These are historical cases that are similar, close to a bear market, but didn't close below 20%. Average gain a year later in those cases, over 30%. Every single case the market was higher. Capitulation indicator recently signaled it's extremely rare, and performance walking forward on an annualized basis is silly. When this type of reversal occurs historically, good things tend to happen. Hearing Timber from Fidelity, that suggests that investors have priced in enough pain to make it worth taking the other side. Tweet dated April 18th, 2025. He also noted on April 18th that the relatively tame move in the credit markets suggests that the hit to earnings might be contained. Massive flows into money market funds and cash present day here. Similar case here, here, and here. The previous cases all occurred near major turning points in the market and after most of the pain was already in the rearview mirror. We really don't have any hard data in hand at this point that contradicts the secular trend thesis. And typically, within the context of a secular trend, if you give the secular trend the benefit of the doubt, more often than not, that pays off handsomely when the S&P 500 goes on to print higher highs. Having said that, if the data in hand starts to morph into something more like this, or this, or this, or this, or this, then we have to be willing to reassess those probabilities. And we all know the only way that we can do that properly is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.